What's up, everyone? Welcome to the Daily Macro Update for Tuesday, September 23rd. We got a special report for you guys in just about 10 minutes here, or 15 minutes. We're going to be going over live to this conference here that's currently going on right now. But at some point, we will have Fed Chair Jerome Powell speaking, and so supposedly that comes up here at 12:35 p.m. So we're going to keep tabs on that. But in the meantime, while these people are talking and doing their formal introductions that are meaningless, let's take a look at the markets here. S&P 500 having a crazy month in September so far. I don't know if you guys remember, but there was a lot of memes going on online talking about how September is typically one of the worst months for the market. And, even though statistically that may be the case, this has been a great example of you can't just go off of seasonality, right? Seasonality is definitely important. I think it's something to consider, but it's, history doesn't always repeat the same every single year. And so, the whole lesson with this month is to make sure not to get totally hooked up with seasonality. Anyway, we've had a pretty interesting run here in September. Nearly 5% for the S&P 500. Yesterday, it closed right near the top end of the trading range. So, having a minimum position in order to buy the next dip is definitely where you want to be at. There was a brief buying opportunity last Wednesday intraday during the FOMC press conference, but that was about it. We've been seeing a lot of different things have an acceleration this month with small caps. The biggest and best performing ETF so far has been Bitcoin mining stocks. So the Bitcoin miner ETF WGMI has been the best performer in terms of ETFs. Within this ETF here, let's see. I think the best performer, if we go to holdings, so IREN has been the best performer. So if we just go to that chart right here, it's the biggest weight within the WGMI stock. And so, this stock here has been just an incredible performer so far this year. Let's see, since the beginning of 2025, it's up over 300%. If we take a look at where it was at the bottom from the sell-off, it's up, over 690%. So IREN has been, on a complete tear. Interestingly, this looks a lot different from the Bitcoin chart itself, right? And typically you don't see that. I think you're just seeing a ton of flows go into these Bitcoin miner stocks, and I think it'll continue. Despite Bitcoin kind of just going sideways here recently, I was buying a little bit of Bitcoin from yesterday's historical long liquidation. I'm not sure if you guys saw that yesterday, but I think it was one of the largest long liquidations in history. If I go to my profile here, let's go to yesterday. Yeah, so if you take a look at the total liquidations chart for Bitcoin, yesterday was one of the largest long liquidations in Bitcoin's history, over $1.6 billion in a single day. That was the main reason for the large sell-off. As you can see, if you go back to the Bitcoin chart here and we bring up an indicator of volume, you can see that despite yesterday's sell-off, there wasn't really much volume on that sell-off, right? So, not as similar as to these sell-offs over here. It wasn't really it was a decent amount of volume, but definitely not a large volume spike. And so that went right down to the low end of the trading range, and I was buying some yesterday. Nice little pop today. We'll see if that continues. I wouldn't be surprised if it does face some headwinds, though, only because we are seeing a large decline in net central bank liquidity, which is something that we've also been noting. If we go back all the way from the bottom in 2022, you guys can see how, net central bank liquidity has been on a pretty decent run up ever since the bottom in July of 2022. If you overlay a chart of Bitcoin on this liquidity chart here, you can pretty much see how, Bitcoin and central bank liquidity are pretty much in tandem, right? There are certain periods in the short term where they might be oppositely correlated, but in general, Bitcoin tends to follow this chart. And, as of right now, I mean, we see a pretty large gap between these two. So we'll see what happens with Bitcoin. Wouldn't be surprised if it does experience some headwinds from here, but that is definitely something to keep track of. Dollar remains in bearish trend. The government and the central bank are easing at the same time, despite inflation being above their 2% target, all the way at 3%, with it continuing to accelerate. This is part of the reason, or actually the main reason, why you're seeing gold do something like this. And so I hope people are paying attention to what's going on right now, because this is pretty historic. Gold does not do this on its own. Gold making this move right now is just a broader signal that the government is making a mistake here. When I say the government, I mean both institutions that are in Washington, fiscally, which is the actual government, right, Trump, and then you also have the central bank, which is Jerome Powell, and the rest of the Federal Open Market Committee, the FOMC. Looks like this guy is still yapping here. Okay, they went to a quick break. Getting into some of the different macro data for today, we got the Redbook Index, weekly retail sales report that had a decent little correction there, still remaining elevated. We got the flash PMI for both manufacturing, which is showing, still elevated reboundness, right? I wish I could go back even further from this. For whatever reason, I can't. But, you can clearly see, even if you just block out the noise, that this has been on a general uptrend from 2023. And then if we take a look at services PMI, that pretty much has remained flat to slightly higher over the past year or so. But in recent months, it has had a little bit of a decline from the average that we saw in the second half of 2024. We got the Richmond Fed Manufacturing Index, which that remains in deep contraction there. Richmond Fed manufacturing shipments continue to decline, as well as service revenues is having a little bit of a rebound here, but still remains pretty low. So yeah, seeing that services and manufacturing within this sector are still declining, or at least slow. I really don't think that we're starting to see a huge across the board rebound in growth. I think it's something where it's still going to be pretty slow or stagnant, right? And so I think the stagflationary environment is going to continue, but obviously, large mega cap tech stocks, credit spreads are very tight. The dollar remains bearish. And so, stocks pretty much perform well, even though the real economy is showing signs of slowing. So that is pretty interesting there. When taking a look at the target rate probabilities for the next Fed meeting on October 29th, there is over a 91% chance that they are going to cut by 25 basis points again. And so really, again, this is happening as inflation is accelerating. And right now, the market is completely on board with the Fed, with their guidance that that inflation is transitory right now. So that is pretty interesting there. But, just looking at the Cleveland Fed's the Cleveland Fed's inflation nowcast, you can see for the month of September, across the board, it has essentially all of the main inflation indicators accelerating to 3% and could be going higher from there. And, you can look at the video that we did last week. But, seeing that when we look at the services component, excluding shelter, that's had a pretty decent acceleration over the past 6 months. And so the reason why I bring that up is because, Jerome Powell mentioned how the services sector is coming down in inflation, which is not tied to tariffs, right? Because mainly Jerome Powell is blaming most of the inflation right now as mainly due to the tariffs, but that is just not true. If we take a look at CPI services, less shelter, right? So we just get rid of like rent, the rent component. Let's see, services less energy. Where is it here? Okay, services less rent. Here we go. So this is essentially core services, better representation. Zoom in here. As you can see, ever since March, it was at 3.3%, and now it's at 4.0%. So over the past, 6 months here, services inflation has actually been going up, despite what Jerome Powell keeps on telling people when he goes on TV. So complete liars. Let's go ahead and take a look at the yield curve here. This is the current yield curve for the United States. If we take a look at what this transitioned from just 3 months ago, as you can see, we've had a continued steepening of the yield curve, but everything is just lower. Both the 10-year and the 2-year have declined at the same time. When going back and comparing it to 6 months ago, you can see that the yield curve was pretty flat and has steepened, but has mainly been due to the low end of the yield curve coming down, meaning that, pricing in rate cuts, right? Really hasn't changed too much on the long end, although slightly down on the 10-year, right? And then what's interesting is that if we take a look at the yearly change in the yield curve, you can see a pretty interesting change here. So the 2-year yield is almost unchanged year over year, right? September 23rd of 2024, it was at 3.54%, and right now it's at 3.58%. So really about a 4 basis point difference. That's really not much at all as far as the 2-year, right? But we see a massive difference on the long end of the curve, an acceleration actually, right? So the long end of the curve is much higher compared to this time last year, right? So 30-year bond yields are up, over 70 or about 70 basis points, meaning that, from the year-over-year change in growth has been slowing. What has accelerated? Obviously, the inflation component. And so the yield curve and the bond market is signaling that inflation is remaining a problem. Now, when combining all of these and taking a look at the 10-year minus 2-year yield curve, we have an interesting dynamic here. Let me go ahead and actually transition over to the 2-day time frame just to get a little bit of a better look here. And looking at this at a longer time frame, going back all the way, let's just go last year, you can see that pretty much, there was a steepening for the majority of last year, including this year, and then the yield curve has pretty much flattened out since April of 2025, even though there has been some steepening, and you can definitely see the bull steepening because of the rate cuts. But just looking at the longer term time frame, you can see that the yield curve has remained relatively flat, right? It's currently at 0.54%, which is similar to where it was at all the way at the end of April, right? So that is definitely interesting, and it's bull flattening, meaning that the long end of the curve has actually come down slightly more than the short end of the curve, despite the rate cuts, showing that the yield curve is signaling more of a slowing growth type of environment. That's basically what it's showing here. If this was showing more of a bear steepening, which is where the 10-year yield rises faster than the 2-year, then that would actually be a better signal from the bond market in terms of growth. But that's not what we're seeing here. So that's pretty much all I have for you guys here. Let's go ahead and tune into the Fed meeting here. It's not a Fed meeting, it's a speech by Powell, but let me go ahead and switch over here. So just give me a second while I change screens so that you guys can hear what's going on. And then we'll go ahead and take a look.
Security and ongoing prosperity.
Let me know if you guys can hear
Senator,
that.
we are grateful for your support for this event, for the work of the Greater Providence Chamber of Commerce, your advocacy for our members and their businesses, and for being a champion for our state and putting into practice each and every day the values that you learned at that kitchen table on Pontiac Ave in Cranston. Senator Jack Reed.
Is Powell coming on?
Well, thank you very much, Rick, for that extraordinarily kind introduction. I also want to thank Lori White for her great leadership and all the members of the Greater Providence Chamber of Commerce. To all my colleagues in government, thank you for joining us here today. I want to particularly shout out to Susan Collins, the president of the Federal Reserve Bank of Boston, an extraordinary public servant, and President Mark Palange of the University of Rhode Island. He has really taken a great university and made it even greater. Thank you, Mark. Today, I have a distinct honor. That is to welcome Jerome Powell, the chair of the Federal Reserve, back to Rhode Island. Along with many of my colleagues on both sides of the aisle, I have long appreciated Chairman Powell's decency and steady leadership and commitment to the values that distinguish America from every other country in the world.
Oh yeah, central bank running our entire country into the ground. Very distinct.
And reappointed by a Democratic president. He has shown the courage to make tough decisions in an exceptionally challenging economic and political environment.
Like being too late.
And he has made these decisions based on the data and the facts and good analysis. And
lagging data.
Increasingly rare these days. It feels like a much different world today than the last time Chair Powell addressed us in 2019. The COVID-19 pandemic brought substantial economic upheaval, including unemployment rates we had not seen for decades. That crisis was followed by a serious bout of inflation. And in fact, every economist, left and right, were predicting not about the coming recession, but how severe it would be. Because of Jerome Powell, there was no recession. Chair Powell deserves credit for navigating those
not for rich people.
Waters. Nevertheless,
definitely not a recession for rich people, but for the
Americans
bottom
are still
50%,
significant economic
it's been a
challenge
depression.
due to the chaotic policy agenda of the current administration. Tariffs, health care cuts, a massive debt increase, and interventions in the operations of major corporations and universities have all proved disruptive and costly. Real wages for most American workers remain stagnant. We still have not fully tamed inflation. Roughly 36 million Americans are experiencing poverty, and housing is too expensive and in too short
You just
supply
said that
everywhere,
we're in
but
economic
particularly
prosperity.
here. The policy chaos is extended into a direct assault on the Fed's independence and personal attacks by the president against members of the Fed. But Chair Powell has met these challenges with equanimity and professionalism. He understands that a strong and independent central bank can contribute to sound economic policy in this nation. He understands the impact that monetary policy has on communities and families and businesses. He has somehow managed to stay laser focused on achieving the Fed's dual mandate to achieve maximum employment and stable prices. Chair Powell, thank you for doing your job with honesty, integrity, and humility. I speak for all of us here. There are few examples of patriotic, decent dedication.
He's got a Ukraine flag on his
and thank
pendle
you for
there.
returning to the Providence Chamber during your final few months as
Must
Fed
be a
chair.
Democrat.
You are more than welcome. Ladies and gentlemen, would you please join me in welcoming Chair of the Federal Reserve, Jay Powell.
Watch this be a nothing burger. Probably will, actually. Jerome Powell all glazed up.
Thank you for your warm reception, and thank you, Senator Reed, for your very kind introduction. It is a pleasure to be back in Rhode Island. The last time I had the opportunity to speak to the Greater Providence Chamber of Commerce, as Lori mentioned, was in the fall of 2019, actually November 25th, 2019. And I said then, quoting, "If the outlook changes materially, policy will change as well." Well, little did any of us know, just a couple of months later, the COVID-19 pandemic arrived. Both the economy and our policy evolved dramatically in ways that no one could have predicted. Along with actions by Congress, the administration, and the private sector, the Fed's aggressive response helped stave off historically severe downside risks to the economy. The COVID pandemic came on the heels of the painfully slow, decade-long recovery from the global financial crisis. And these two back-to-back world historical crises have left behind scars that will be with us for a long time. In democracies around the world, public trust in economic and political institutions has been challenged. Those of us who are in public service at this time need to focus tightly on carrying out our critical missions to the best of our ability in the midst of stormy seas and powerful crosswinds. Throughout this turbulent period, central banks like the Fed have had to develop innovative new policies that were designed to deliver on our statutory goals during times of crisis, rather than for everyday use. Despite these two unique, extremely large shocks, the U.S. economy has performed as well or better than other large advanced economies around the world. And as always, it's essential that we continue to look back and learn the right lessons from these difficult years, and that process has been ongoing now for more than a decade. So, turning to the present day, the U.S. economy is showing resilience in the midst of substantial changes in trade and immigration policies, as well as in fiscal, regulatory, and geopolitical arenas. These policies are still emerging, and their
the government's printing crazy
implications
amounts of
will
money,
take some time to
and
be
it's holding
seen.
everything up.
Recent data show that the pace of economic growth has moderated. The unemployment rate is low but has edged up. Job gains have slowed, and the downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In recent months, it has become clear that the balance of risks has shifted, prompting us to move our policy stance closer to neutral at our FOMC meeting last week. GDP rose at a pace of about 1.5% in the first half of this year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. Activity in the housing sector remains weak, but business investment in equipment and intangibles has picked up from last year's pace, largely reflecting the AI build-out. As noted in the September Beige Book, which I bet you wonder what it is, the September Beige Book, that's a report that gathers qualitative information from across the Federal Reserve System. We'll talk about later. Businesses continue to say that uncertainty is weighing on their outlook. Measures of consumer and business sentiment declined sharply in the spring. They have since moved up, but remain low relative to the start of the year. In the labor market, there has been a marked slowdown in both the supply of and the demand for workers, an unusual and challenging development. In this less dynamic and somewhat softer labor market, the downside risks to employment have risen. The unemployment rate edged up to 4.3% in August, but has remained relatively stable at a low level over the past year. Payroll job gains slowed sharply over summer months as employers added an average of just 29,000 per month over the past 3 months. The recent pace of job creation appears to be running below what we call the break-even rate, that is the rate needed to hold the unemployment rate constant. But a number of other labor market indicators remain broadly stable. For example, the ratio of job openings to unemployment remains near 1, and multiple measures of job openings have been moving roughly sideways.
That's because the labor pool is shrinking.
Claims for unemployment insurance. Inflation, meanwhile, has eased significantly from its highs of 2022, but remains somewhat elevated relative to our 2% longer-run goal. The latest available data indicate that total PCE prices rose, that's personal consumption expenditure prices, that's the inflation measure that we follow most closely, rose 2.7% over the 12 months ending in August, up from 2.3% in August 2024. Excluding the volatile food and energy categories, core PCE prices rose 2.9% last month, also higher than a year ago. Goods prices, after falling last year, are driving the pickup inflation.
No, they're not.
Incoming data and surveys suggest that those price increases largely reflect higher tariffs rather than broader price pressures.
Incorrect.
Disinflation for services continues, including for housing services.
Incorrect.
Near-term measures of
Oh,
inflation
housing,
expectations have moved up on balance over the course of this year on news about tariffs. Beyond the next year or so, however, most measures of longer-term inflation expectations remain consistent with our 2% inflation goal. The overall economic effects of the significant changes in trade, immigration, fiscal, and regulatory policy remain to be seen. A reasonable base case is that the tariff-related effects on inflation will be relatively short-lived, a one-time shift in the price level. Now, a one-time increase does not mean all at once. Tariff increases will likely take some time to work their way through supply chains. As a result, this one-time increase in the price level will likely be spread over several quarters and show up as somewhat higher inflation during that period. But uncertainty around the path of inflation remains high. We will carefully assess and manage the risk of higher and more persistent inflation. We'll make sure that this one-time increase in prices does not become an ongoing inflation problem. Turning to monetary policy, near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation.
I wonder if he's saying they're going to
If we maintain
not cut as
restrictive
much.
policy too long, the labor market could soften unnecessarily. When our goals are in tension like this, our framework has long called for us to balance both sides of our dual mandate. The increased downside risks to employment have shifted the balance of risks to achieving our goals. We therefore judged it appropriate at our last meeting to take another step toward a more neutral policy stance, lowering the target range for the federal funds rate by 25 basis points to 4 to 4.25%. This policy stance, which I personally see as still modestly restrictive, leaves us well positioned to respond to potential economic developments. Our policy is not on a preset course. We will continue to determine the appropriate stance based on the incoming data, the evolving outlook, and the balance of risks. We remain committed to supporting maximum employment and bringing inflation sustainably
It's interesting how
to our 2%
he
goal. Our success in
focused on
delivering
inflation
these
more
goals
this time.
matters to all Americans, and we understand that our actions affect communities, families, and businesses across the country. So thank you again for having me here, and I very much look forward to our discussion. Thanks.
It's pretty interesting how he focused more on inflation this round. Could be a signal that they might not cut as aggressively. We'll see what happens. Market reaction is neutral right now. Except for gold.
Thank you very much. Good afternoon once again, Mr. Chair. Thank you for those opening remarks and reminding us just how tremendously the world has changed and evolved since you were last here in 2019. President of the Federal Reserve Bank of Boston, Susan Collins, is also here with us today. And President Collins, we have had the opportunity many times to discuss with you the conditions in this Fed region, of which Rhode Island is part of the Boston region. So, Mr. Chairman, I would ask you to think about your comments reflecting on the importance, what you have said, the importance of deeply understanding local labor markets. And I'm wondering if in your deliberations leading up to the most recent FOMC meeting, whether there was anything particularly distinctive in what you saw coming out of the Boston Beige Book.
So let me say a word about the Beige Book. So there are 12 reserve banks, as you know, around the country,
and each of them has deep ties into not just the business community, but medical community, educational community, nonprofits. And each FOMC cycle, which is sort of 8 of those a year, they do a deep dive and they collect lots and lots of information about the economy. And so, that information gets collated and put into what we call the beige book, because it's beige. And we're not that original. And so we get that a couple weeks before each FOMC meeting. And I have to say, I don't know of any source of sort of qualitative information about the economy that even approaches this. It's just a lot of conversations with a lot of people, and I personally find it very useful. Sometimes you look at that book and you see significant regional differences, and this is not one of those times. So, for example, the Boston Fed piece in the last beige book talked about lots of spending on AI. Well, guess what? That was pretty common across 8 or 9 of the districts.
AI.
So, I would say nothing really jumped out from the Boston piece. What you saw was all around the country, you saw pretty modest growth, wage and price inflation at modest to moderate levels, the economy growing but not fast, and uncertainty, significant uncertainty about federal public policy is kind of weighing on investments and the decisions about investment and hiring, except in the area of the AI build-out, which is just going really strong pretty much in many parts of the country.
So nothing distinctive from the Boston region that would inform your future decision-making, looking at the setting of monetary policy?
What I saw from Boston was quite similar and overlapping with a number of other districts. Again, sometimes that's the case where things are pretty much of a piece. Sometimes different regions, particularly if there's a commodity price thing.
I'm not sure if we're going to be seeing any actual good questions asked. A lot of these people who get on these panels are just, butt sniffers.
It's much more the same around the country.
Maybe we'll find one
So
question.
let's talk about and build on what you described a few moments ago about the dual mandate of the Fed. And if you could talk about these conditions that wax and wane over time, what signals will you be looking for in the run-up to the next FOMC meeting, which is in roughly 30 days?
We have 2 goals, as you mentioned, maximum employment and price stability, and they're equal goals under the law. So almost all the time, they work together. They complement one another. So, for example, when the economy is weak, the unemployment rate might be high and the inflation rate would be low, and that it calls for stimulus from us. And when the economy is really strong and the labor market is tight,
I wonder if she'll ask
when
about the
inflation will be moving
quote-unquote
up,
third
and so
mandate
policy might be a little bit tighter.
of lower,
That's
longer-term rates.
almost always the case. Right now is the quite unusual case where risks to, as I mentioned in my remarks, risks to employment are to the downside and to inflation to the upside. Now, we only have one tool, which is monetary policy, really interest rates, and really it's calling for different answers. So for a long time, we have a document called the Statement on Longer Run Goals and Monetary Policy Strategy. We call it the consensus statement to save time. That says, for a long time, it's said that when the 2 goals are in tension, we'll look at how far each one is from its goal and the time that it's expected to take to get back to that goal. And so we balance the 2 goals. So what we've done all year this year is we've had our policy rate has been tight because inflation has been above our target, but the labor market was very solid. Now, over the last really 4 months, really over the summer, the labor market has softened, payroll jobs have dropped a lot, so we can't really say that anymore. And I think what that told us is that stance of really having a tight focus on inflation really needs to moderate toward a more balanced approach. And so that's why we took the action we took at our last meeting. And as we go to our next meeting, to your question, we'll be asking ourselves, we'll be looking at the data very carefully, labor market data, growth data, inflation data, all the vast quantities of data that we get, and asking ourselves, is there a policy in the right place? And if not, we move it there.
Some may wonder about the frothiness of the markets, the markets reaching record heights and also record valuations. How does the Fed think about that in the equation?
financial markets.
He's going to say we don't
So
care.
obviously we monitor financial markets very carefully. Our policy works through financial conditions, so that's credit spreads and interest rate levels and you know, equity prices in the aggregate that can affect spending, for example. We look at all of that, but really our focus is on our two goals, and that is maximum employment and price stability. And when we see one of them weakening, you know, we're going to respond appropriately with our tools. And in this case, that meant reducing the federal funds rate by 25 basis points. And, you know, we'll see what the future brings, but that's what we do. We look carefully at financial conditions, more from a perspective, though, of financial stability. So we see that the banks are well capitalized. Actually, in the aggregate, households are in good shape financially. I know people at the bottom end of the income spectrum are under pressure. No question about that, but it's not a time of elevated financial stability risks.
Mm-hmm. So the federal funds rate really governs consumer credit, but not so as it pertains to mortgage rates, correct?
That's right.
And let's talk about how the average consumer is going to see any difference in the intervening months relative to in easing of interest rates and the ability and maybe even more confidence.
It makes no
to spend.
sense.
So we don't set mortgage rates, but when we change the federal funds rate, it will affect the mortgage rates and also all other consumer borrowing rates. Really, all interest rates that are on a floating basis will move a little bit or even a lot if they're short term, based on our moves. So the people will feel that over time. Also, it's not just these days. The market is pricing in the next 6 months what's going to happen to rates. So this is something that wasn't really the case, 50 years ago. Now markets listen to us and follow, and they make an estimation of where they think rates are going.
The markets are
they'll
pricing
price
in
things
perfection
so,
right now.
Longer term rates
soft landing
will
is
move
basically
because of
guaranteed.
what the market participants expect us to do. So you'll begin to see, and you're already seeing, changes in rates long before we make the decision. It can often be already, priced in.
Is it fair to say that the Fed and the markets really have a higher tolerance for risk today, more so than perhaps before the pandemic?
No, they're all crowded
I think
into the
if you
Mag
look at
7.
some prices, then they're elevated relative to historical levels. There were times before the pandemic when it happens periodically. Equity prices will move up and down, and we do monitor that. But we're not targeting any level
Powell, you've
of
caused them to
prices
go
for
straight
particular
up.
financial assets. We don't have a view that we know what the right price of any particular financial asset is. We do look at overall financial conditions, and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve. But you're right. It by many measures, for example, equity prices are fairly highly valued.
Let's segue to the topic of AI and largely AI
Basically
stocks
just
and
agreed.
periphery stocks really driving the markets in many ways. Let's talk a little bit about the great unknown of AI, and if we think about various
Why is this lady
ages, our
asking him
industrial
about
ages,
AI?
whether it be steam to electricity to the information age, and now to
He's
the
just
age
going to
of
respond and be
AI.
like, yep, pretty cool stuff.
Would you consider this to
Yep.
be the most disruptive force ever in modern American history?
I think it's way too early to say that. I wouldn't go that far. I would say clearly generative AI has all the earmarks of an emerging technology that could be very important in our economy and in our society. But it's very early to be making that kind of bold statement. So, what we're seeing is companies and institutions
He must have
like the
sold
Fed,
his
for that
AI
matter,
stocks before the
are
meeting.
starting to experiment with how this new set of tools can be used in our operations. And it's very early days on that. And, I think we have to wait and see. That's a good thing. I know many of the large financial institutions and other central banks, and we are asking ourselves, how can this help us do our jobs better? And I think it's going to be a period of experimentation over a period of years. And, the history is always that there's a lot of fear that technological innovation will eliminate jobs. What has tended to happen in history over time is that it just raises productivity and creates new jobs
to replace the old jobs. And that happens. And sometimes it can take a long time, but ultimately that has been the pattern for the last couple of 100 years. Is this time going to be different? I just don't think we know yet. I don't think anybody knows.
You are a labor market futurist, also a historian, and the concept of AI and humans in the loop, very profound impact on the labor force. What are your thoughts about specifically agentic AI as a differentiator from generative AI, and how will the Fed be looking at the impacts of the workforce, the labor participation rate, given the unknown of what could happen with displacement around AI tools at all ends of the spectrum?
What are these questions?
Our tools work on demand, basically. Lower interest rates, higher interest rates, they work on demand. When there are structural changes in the economy, there's not a lot that an interest rate change can do for that. And so
Glad he just
if you're
admitted
talking
that.
about distributional issues,
Everything
or
since
labor
the
force
pandemic has been
participation,
supply-side
or
issues.
retraining, or any of the things that come to mind in connection with those questions, that's really going to be something for legislators and the private sector. We of course,
He
have
just admitted that
many labor
the
economists,
Fed's
and
useless.
a good portion of them are studying what the potential effects of AI on the labor force, and many great economists around the country and around the world are publishing on that now. And you know, it really is too early to say. I think you can say that some jobs are going to be phased out, some jobs are going to evolve, and people are going to be further trained and that sort of thing, and be able to keep a job like that. And there'll be new jobs that come. And how will that balance work out, and what will be the timing of it? I think it's just quite hard to say.
But how does that factor into the deliberations on a near-term basis? Things are moving so quickly, and really the observation and the argument that artificial intelligence isn't just impacting those entry-level jobs and those, quasi-unskilled jobs, but really tentacles reaching into highly skilled professions, whether it be finance, whether it be communications and media, whether it be healthcare, whether it be law, finance. So all ends of the spectrum, highly educated individuals down to more easily automated tasks.
Lady,
sort of a
this
really
guy can only
interesting
control interest
problem
rates.
For those of
What
you
are these
that are studying
questions?
labor market economics. How do you approach that?
Well, a lot of what we're doing with our time is trying to understand the current position of the economy, what's actually going on in the economy today. Pardon me. So part of that is hiring rate has really dropped. Job creation has
Jerome
dropped
Powell,
very sharply.
keep
So
coughing. Stop smoking
what are
all
the
that pot,
factors there?
dude.
So I mentioned earlier, I think, part of it just is there's a lot of uncertainty about the direction of public policy, and so companies are holding off. They're not hiring, and when you don't hire through attrition, your labor force shrinks, and you save money that way. That may be a way of passing on tariff costs. It may be something like that. So that's happening. Lots of questions around whether AI is a major factor associated with the relatively low hiring rate for people just graduating from school and just entering the labor market. And people are doing studies on that, and I looked at one from Stanford, another from the New York Fed in the last week, and the sense of it was, we think we can find some evidence that generative AI is having some, it's one of the reasons here, but we can't really say it's the main reason. And we have our Jackson Hole conference every year in Jackson Hole, Wyoming, and we had some great labor economists, and one of the big debates was what's going on with AI, and there was a professor from, I want to say, Columbia, who just basically said there's no evidence that this is acting any differently than her view was not acting any differently from other technological movements, waves. And so I think she would be more at the end of an optimist, a techno-optimist. We've all, there are books out there that will tell you the world is ending, and but I don't think we know. Again, I think we're going to see how this evolves, And again, if it does turn out to be something where labor force participation really declines in a way that creates, social difficulties, that's going to be something that legislators and the private sector will have to address. We just don't know that yet, though.
His answer
Over the
to your AI
weekend,
questions
I read
is
where you
it
had
has
been
nothing to do with
discussing,
us.
just picking up on what you said about Gen Z and college graduates and any possible disruptions in trying to find jobs. So Gen Z would be those born between 1997 and 2012, roughly ages 13 to 28. What are your thoughts on college enrollment? We'll talk a little bit about labor disruption.
What are
in
these
just a minute,
questions?
and Jackson Hole, because I know that's a favorite of yours. But a lot of the individuals in this room today may have family members that fall squarely in that 13 to 28 category. What would you say about that?
I mean,
Does this
again,
lady understand that he's not
we
a
all see the
politician?
data that it's just gotten tough for people just entering the labor force to be hired. But remember, the overall
guy isn't running
national
for office.
aggregate hiring rate is at very, very low level. The layoff rate is also at a very, very low. You're in a low fire, low hire economy, and it feels like companies are they've kind of stopped hiring or slowed down their hiring because they want to see how this all shakes out. We're having very important changes to economic policy in the United States, and companies and people are wondering how's that going to work out. So I think that's part of it. The other thing I would add, though, is there's a lot of good scholarship around technological innovation and inequality, if you will. And the sense of it is really that if schools and society give students
We're 30 minutes
graduating
into
the
this
skills
thing,
and aptitudes they need to benefit
and there's
from
not even a
evolving
good
technology,
question that
you
hasn't
can
even
have
been asked
declining
yet.
inequality over time. And that's what the United States had for many, many years, up until about 1970, when U.S. educational attainment kind of plateaued and inequality takes off. So it's really down to having the skills. So kids who come out of school today with technological skills and can work with this new technology, they're probably going to be fine. They're going to be great. If you don't have those skills, though, you're increasingly left with less attractive employment options.
Not
So
much of a market reaction.
In a way, it's an educational issue.
Our society is our education system, and you spoke about inequality, particularly the digital divide, and thinking about where the United States really has paced among countries throughout the world. Particularly, that was a subject that you initiated at Jackson Hole back in August. What are your thoughts on how that is likely to really change the way we look at technology as a force for productivity and advancement?
I mean, technology has been raising incomes.
You're
and
completely right,
productivity
Artemis. I
for
wasn't expecting
really
much.
a couple hundred years since the Industrial Revolution. It's been an amazing thing for the quality of human life, and there's no reason why that has to change. In the United States was the first country to have gender-blind secondary education, and if you go back, you'll see that there's a great book on this, but just basically the U.S. had fast technological innovation for a century, and also declining inequality because people were coming out and their educational the capabilities they took out of the educational system gave them the ability to benefit from evolving technology. So, and that's really the key, because technology, what it does is it makes us more productive. One summer I worked on a project that was building houses, and I basically had a shovel and I just dug most of the summer. And now that would be a Bobcat, which can do 100 times the work, no blisters, no water breaks.
How old are you, Jerome Powell?
You see housing production's gotten, at least it did get for a while, much more productive, not so much lately. But that I think is the story. And while U.S. educational attainment, college graduation rates and things like that leveled out, they're still going up. The rest of the world caught on and has really caught up in terms of educational attainment. And that really is the key. To your point, your educational system, your country is your educational system ultimately. It's the people that come out and what can they do, and a variety of other factors too, obviously. But I think that's a key element. I'm struck by this because this was a major factor at our recent conference, and we had a great conversation about it.
Well, tell us about the book. You gave me a homework assignment the other day, so I did download it, but I think everyone should follow that lead.
All right. It's a book's called The Race Between Education and Technology. It's by Claudia Golden and Larry Katz, two Harvard economists, and it basically talks about the race between education and technology. So I recommend that to anybody. It was written in, I want to say, 2005, and they basically presented at Jackson Hole, they presented an update to the current day. The findings basically hold. It's very, I mean, I'm not a PhD economist. I read it 20 years ago.
But you said it still holds very much true today.
It does. And I think it's a good explanation for why the U.S. has had, rising inequality. This is their thesis, and I think it's they call it also skill bias technical change. So you need skills to benefit, but if you have those skills,
I'd call it a central
technology
bank
makes you
that
more
keeps
productive.
devaluing our
That's what we
currency
need.
and
Incomes
inflating
can
away our
only
purchasing
rise
power.
If productivity is increasing.
That book
We're sort
should
of
just
working as
have
many
one
hours
word
as
or
we
two
can
words
work
and
now.
one
So it really
chapter,
is
and
down
all
to
it says is
how
central
much
banks.
output can you have in an hour, and that's productivity. So I would recommend that. I'm not getting any royalties for that, but by the way, Claudia Golden won the Nobel Prize for
Not getting any
for her
royalties.
work about 2 years ago. So
Aren't you worth like
I'm not the
$20
only
billion
one that
or
thinks it's
something?
good work.
Chair Powell, let's
Jerome
move
Powell
on
net
to
worth, let's
tariffs.
see.
This is an issue that confronts the business people and here with us today.
His net worth
You
ranges
addressed it
between
very
20 million and
briefly in your
55
opening
million.
remarks. You indicated that you believe that the costs of
He's making royalty
the
jokes.
tariff movement is in fact more transitory than embedded in supply chain. So I think we would appreciate hearing more about how the Fed thinks about evolving tariff policy.
So we're now collecting a good bit of revenue. The federal government collecting a good chunk of revenue, at a $300 billion a year pace. And the question is, who's paying that? And the candidates for paying those tariffs would be the exporter, the foreign exporter, or someone on our shores. It could be a company or a retailer, or someone who's using the imported product to manufacture something, or the end consumer. And so so far, in its incredibly early days, it doesn't look like the overseas exporters are carrying the bulk of it. It looks like it's that middle group. It's retailers and it's importers, and they're not passing along to consumers that much of the cost. So the actual effects on inflation have been quite modest so far. It's really not. It's a small amount, but I mean, for example, I mentioned that core PCE inflation is 2.9%. Maybe 0.3 or 0.4 of that is tariffs. So it's not the big factor. It's not a big inflationary thing, but it is something that is driving up inflation a bit. And the question is, are companies then, are they going to eventually be able to pass that stuff through? And then that might drive inflation up a little higher. So we've been watching this since the beginning. Half our mandate is inflation. And I would say that the pass-through to consumers has been later and less than we expected. How much of that will continue, I don't know. But the responsible thing from our standpoint was to watch and wait, because it's our job to make sure we don't make a mistake on inflation.
Well, that was my question. Do you imagine that is going to change, where the cost of tariffs will be more deeply embedded and passed on to the consumer? What do you foresee as?
So our forecast, and I think almost all the forecasts are for there to be a one-time pass-through, which will go through the end of this year, well into next year, and that by the end of next year, the one-time increase from the tariffs will be done, and you'll be back to the non-tariff related inflation, which should be much closer to our 2% goal. That's almost everyone's base case. It's actually our job to make sure that that's the outcome, though. So we can't be in a situation where we're just going to assume that. We can't leave that part of the goal unguarded. And so that's why we've been careful about cutting. We didn't want to cut too early. I mentioned in my remarks, if we cut too early, we may find out in a year that inflation actually wasn't under control and it's back up to 3.5% or 4%. No one thinks this is the base case, but that's the risk of cutting too early or too much. Of course, the risk of cutting too late, as I mentioned, is that we unnecessarily, the labor market weakens unnecessarily. It's there's no risk-free path, and it's a very difficult policy environment when your two goals are telling you two different things. You've got to make a compromise, and we really, again, haven't been in that situation for many, many years. It does happen, but it's happened now, and we'll manage our way through it. But we sort of have to look at both of them as equal. We can't just say we're going to do this one and not that one, unless this one is clearly a greater risk. And now they're coming into closer balance, I would say. We do see meaningful weakness in the labor market now, very low job creation. The unemployment rate's still low, though, and the quits rate is low, and a lot of things suggest that the labor market has reached a kind of unusual stability of much lower demand and much lower
That's
supply for
because the
workers.
labor
It's a
pool
really
has
unusual
shrunk.
kind of a balance, if you want to call it that, but nonetheless, we think it's downside risk.
Well, if you could elaborate,
Doesn't
what are
make
some
any
of the
sense,
factors that,
what he just said.
that are leading to depressed demand for labor?
So depressed demand for labor, based on surveys and talking to people who are doing hiring, a big chunk of it is that they're just unsure about what to do. Businesses, and I'd love to talk to people after this. Businesses don't want to do a lot of hiring. They may be postponing major capex, major initiatives, major acquisitions, and maybe they'll replace workers who retire, but they're not looking to grow. This isn't every company and every part of every company in the world. It's just an effect kind of at the margin. That's got to be part of it. I think that's the demand side. The supply side, of course, has a lot to do with immigration policy. So immigration was at a very high level for 2 or 3 years before this year, and
Under
now
Biden.
immigration has really gone close to zero, and immigration is not really contributing to the labor force growth now, whereas it's been most of what the labor force growth
Yeah, because
was.
there's no
And
there's
now,
no
so
native-born
at the same
people.
time, you've got declining demand.
The
and
native
also
population in the
declining,
United States is
declining
in
supply of
contraction.
workers, of new workers.
One of your passions is demystifying the Fed. You enjoy speaking about it, and those that are Fed watchers are wondering, will there in fact be 2 additional rate cuts before the end of the year?
We're
Of
going to be
course,
data
we're
dependent.
uncertain about that, if I understood your comments correctly. What does it mean to demystify the Fed, and what can each of us in this room do to be better Fed watchers for the benefit of our own businesses, if you will?
So not so many years ago, maybe 40 years ago, and for a long time before that, the main theory of central banking was to be mysterious and obscure. In fact, Montague Norman, who's a very famous former head of the Bank of England, but ending in the middle of World War II, famously said, never apologize, never explain. And he thought that monetary policy worked back, and everyone thought it works best when no one understands. It's kind of mysterious. So starting maybe 40 years ago, a bunch of economists, including Alan Blinder and a number of others, said, you know what, that's wrong, because if markets and the public understand the way you'll react to incoming data, then they'll kind of do your job for you. And so they argued for greater transparency. And people said, you know what, that makes sense. So central banks started being transparent. The Fed didn't even issue a post-Federal Open Market Committee announcement until 1994, and then did so as an experiment just to see what would happen. Now, so if you fast forward through, the 30 years since then, now we have a post-meeting statement, we have minutes, we have press conferences, every FOMC participant
press
is
release.
on Squawk Box, we have a press release. So, and maybe some people say it's too much, it's excessive, but so that's the way it's evolved. So we try really hard to communicate with the interested public in a way that is useful and comprehensible and jargon-free. That's what we focus on.
Oh, really?
And that's all we're
Jargon-free.
trying to do. So we don't use their, every profession has their jargon, and you kind of need it for internal conversations, but we try not to do that. So that's all we're trying to do. A couple of thoughts about what, I wouldn't say, I can't make anyone a better Fed watcher, I don't think, but things I would want to tell people about the Fed. One is just this, that we're making decisions, our decisions are made under elevated levels of uncertainty, even in normal times. The economy is fundamentally, no one has been able to predict the economy more than for the next few months. it's an unpredictable, it's this enormous entity, and it's just not that predictable. So we have to manage we take very much a risk management approach, and one of the risks we're managing is that we don't exactly understand what the current state of the economy is and where it's going to go. So we try to have policy that can cover the range of plausible outcomes, not just one outcome. So that's one thing. So we're never saying that we know the economy is going to do this or we know it's going to do that, because honestly, it just, famous statement is, financial forecasters are a humble lot with much to be humble about. So that's one thing I would say. Another is that you should, I just have to say this, whenever we make decisions, we're never, ever thinking about political things. And so we're based in Washington, D.C., and many of people, in Congress, and they're often things are seen through a lens of, is it good for this party or bad for this party or this politician? We're just not looking at things that way. We're looking at what's the best thing for the people that we serve in the medium term. What's the best policy? And many people don't believe us because they think, come on, you're really political. But the truth is, most of the people who are calling us political, it's just a cheap shot. And also, we don't engage. We don't, our argument is doing our jobs. We don't get into back and forth with external people. We just do our jobs. We keep our head down and do our jobs. That's what we do. So
Sure.
Those are two things I would offer about the Fed.
We have run out of time. We have come to the end of our program, and I'm wondering if there's anything additional that you'd like to share with the members here today, and again to help us be more prepared as we begin to look to 2026 and strategic plans for business and things on the horizon that would help to, of course, create more jobs and more prosperity.
So I'll say one more thing that struck me just now about the Fed, and that is, remember, we have a really important job: maximum employment, price stability. We regulate and supervise the banks. We operate parts of the payment system. But those things are really about cyclical demand management and financial stability. The policies that really matter for the U.S. economy in the long run, things like investment, particularly investment in people, that's not something we can do. I think we get a disproportionate amount of attention compared to the things that really matter for the country, which are the things that Congress can do and the private sector can do, which are the things that will really matter for future generations, are not interest rate policy and the things that we do as important as we are. And beyond that, I'll just say this has been great, as always. I've enjoyed talking to so many people here today, and I love to get out and talk to people who are working in the real world and the economy. There's nothing better than that. Most of my career was in the financial sector, and I constantly was out talking to people rather than sitting in my office looking at aggregate data on the economy. So this is a much more comfortable place to be.
You are headed back to D.C. later this afternoon.
Yes.
What does the rest of your day look like?
Get home. I won't get home until after dinner, so it looks like me working on the plane on the way back. So anyway, thank you so much. It's been
Thank
great.
you.
Thank you.
Chair Jerome Powell,
Change the subject.
Chair of the Federal Reserve.
Don't ask what I do. All right. Well, taking a look at that, really no substance at all. The only main interesting thing that I had noticed was that he did mention a little bit more about inflation concerns at the beginning there, which, could be significant. But, I think that as we get higher inflation numbers, right, because this Friday, actually, at 8:30 in the morning, that's when we get their preferred inflation gauge, which is what he just mentioned, which is core personal consumption expenditures, or core PCE. And so, a lot of different projections suggest that that's going to keep accelerating. And if that does, how more can they cut if they think that that number is going to keep going? Obviously, their excuse right now and what the market is really enjoying is him essentially saying that the inflation that's going on right now is a one-time event, which doesn't really make any sense because inflation has been going up for 6 months. So what's his definition of a one-time event? if it's going to create long-lasting inflation. I don't understand that. But yeah, that's the big issue here, and what we can close on is, if you take a look at the 5-year break-even inflation rate, which is the bond markets, trying their best to price in future inflation expectations. I mean, you can see right here, just compared to this time last year when the Fed was cutting rates, this number was around 1.9%. So that's their long-term inflation goal, right? You can see that has risen to 2.44%, which again is much higher. So they had a much more of an incentive to cut this time last year than they are this year. And it doesn't look like this is slowing down anytime soon, right? This is clearly, in a bullish trend here. So we'll see. I think inflation is going to come back to bite them in the butt. And, when taking a look at services inflation minus the housing sector, we can see that this has been accelerating for the past 6 months from 3.3% to 4.0%, right? So nearly 100 basis points higher in just 6 months, with the inflation component that has nothing to do with tariffs. So we'll see what happens here. The fact that gold is doing what it's doing is suggesting that the Fed is going to is messing up on the inflation front. So I hope people are remaining invested and not getting scared, because the Fed is essentially throwing gasoline on all this stuff right now. So. But yeah, gold making this move, great to have it in my portfolio, but it does make me a little bit concerned with the medium to longer term effects of what this is going to do to our current financial system. But, I guess until then, just continue to stay invested and make sure that, in these uncertain times, you're at least, multiplying your money so that it outpaces the rate of inflation, because that's the whole reason to invest anyway, right? It's not just to make money, it's to make sure that your dollar preserves its purchasing power. A lot of people don't think about it that way, but you really have a moral obligation to invest your money. So, but with that, we'll go ahead and close it out. I appreciate everyone for joining. Make sure you catch us tomorrow. We're going to be doing our regularly scheduled timing at 3:45 p.m. for tomorrow's Daily Macro Update. Appreciate everyone for joining. Have a great rest of your day out there, and we will catch you tomorrow. Bye, everyone.